In today's video, we're going to tackle one of the most complex but important questions an early retiree will face. Should you prioritize Roth conversions early in retirement or earning a healthcare subsidy that will save you thousands? Let's find out. First, let's lay out the landscape between these two questions. For those retiring before 65, one of the most common concerns is what you will do for healthcare. The most frequently used option here is Affordable Care Act insurance. Now, some states will have a state-specific system like Covered California, but they mostly work in the same way as the federal system. They are just state-run. One of the most confusing aspects of public marketplace insurance is that costs can vary widely depending on something called your reported income. The lower your reported income, the bigger subsidy you earn, which in turn means you pay significantly less for healthcare. I have an example of this on the screen. These are the exact same plans as noted by the plan IDs. On the left-hand side, we have someone who has earned a big healthcare subsidy by reporting a low income to the government, around $40,000. Their healthcare premiums are $225 a month, which is relatively cheap for a couple. On the right-hand side, I have someone who reports a much higher income and because of it has unsubsidized insurance. They pay the full $2,000 plus per month premium for this plan. Again, these are the exact same plans, but the couple on the left side is estimated to pay $23,000 less for insurance annually. This is a massive savings for an early retiree, no doubt. Notice here that the deductibles and out-of-pocket maximums change based on your reported income here as well. As an early retiree, this is probably the biggest financial planning lever that you can pull to save massively and improve your retirement plan. But isn't there a problem? Who wants to live on $40,000 per year in the case of the subsidy example? Well, here's where some of the magic happens, if you will. By planning strategically, a retiree can live on an income of well over six figures while reporting a much lower income. On the screen, I have a list of things that count towards your reported income. If you pull $100,000, say from your traditional IRAs or 401k, well, that's going to count dollar for dollar against you. But if you pull $100,000 from a Roth IRA, well, that's not going to count against you at all. If you pull $100,000 from a taxable account, well, it's going to depend on how much of that was dividends or capital gains. Say you sell a stock position with 50% cost basis. Well, then selling a $100,000 position will only count as $50,000 of reported income. The point here is you can still live on a significant amount of income in retirement while simultaneously reporting a very small income. But what if you just retired and are projecting out your future tax graph and you see something that looks like this? You have done well saving for retirement in all three tax buckets, but the majority of your wealth is in tax-deferred accounts. Well, once you reach your mid-70s, the government is going to mandate withdrawals in the form of something called required minimum distributions. And so your tax liability is probably pretty low for the first decade of retirement. But then your tax bill catapults into the six-figure range once these RMDs begin. Well, holy crap, you're going to be giving up a ton of wealth to the IRS in this phase of your retirement. Roth conversions are an obvious fix to this problem because by converting your IRAs to Roth, you can do a better job of spreading out that tax liability, and you have a lot of opportunities to do so as we see on the screen in the first decade. But the problem here is that any Roth conversions you do during the ACA years will count against you as reported income. Convert $100,000 and now you have $100,000 of extra reported income. So what are you to do? There are two problems here, or rather two things we're balancing. Tax problems down the road, but also healthcare savings today. Again, which should we prioritize here? I find that most people get paralyzed by this decision and simply make a quick decision one way or another. Some might look at the guaranteed savings of a healthcare subsidy today and prioritize the short-term relief. Others are worried about higher taxes in the future and just decide to pay a little bit extra for healthcare or take a worse healthcare package to try to save in that way. Well, let's dig a little bit deeper before jumping to any conclusions here. Well, let's walk through a situation and let's say we had no Roth conversions restrictions and we didn't care about earning a healthcare subsidy. This is a top marginal tax graph chart showing the tax rate on the last dollar of income you showed in any given year. In yellow is the default strategy with no Roth conversions, and the blue bars show a maxing the 22% bracket conversion strategy. Given no restrictions on conversions, this couple can completely avoid being taxed at 28 and 33% because of RMDs later in life, and they can do so by spreading out their tax liability in that 22% bracket earlier. This couple would end up Roth converting for more than 10 years, but they can fix that higher tax problem with a bit of patience and prudent planning. The problem is they give up that big valuable subsidy in those early years because of it. They Roth convert themselves out of a subsidy. In the next chart and analysis, let's say they didn't do any Roth conversions for the first 4 years and instead prioritize that subsidy. This constrains their tax plannings because they miss out on some valuable conversions earlier and leave those in tax-deferred accounts to compound and grow. Doing this makes eliminating those RMD problems much more difficult. Now, if they look at maxing out the 22% bracket from here, the conversions are still beneficial in avoiding that 33% bracket later. But they still have RMDs pushing them into the 28% bracket. Alongside the higher tax rates, they'll also be subjected to various Medicare penalties along the way as an added expense, whereas in the last graph, they could have avoided Medicare penalties altogether. I'm speaking about IRMA, by the way. So again, the question becomes, what should a retiree prioritize? Earning a big healthcare subsidy or initiate Roth conversions earlier in retirement to fix big tax problems down the road? Before getting into a conclusion, I think it's important to understand a bit more about the healthcare marketplace environment. The subsidy you earn or don't earn is pegged off of a percent of the federal poverty level. If you're a single retiree, the federal poverty level is around $15,000. If you're married or in a family of two, the federal poverty level is about $5,500 more. On the left-hand side of the screen shows your expected healthcare contribution based on these poverty level percentages. If your reported income is less than 150% of the federal poverty level, the benchmark plan will have no premium costs and will essentially be free. At every additional 50% increment of the poverty level, your cost or contribution towards that benchmark plan will rise. Report higher income, pay higher healthcare costs. Now, something that continues to complicate this healthcare environment is that right now, until 2026 actually, this is how your subsidy will phase out. Problem is, this linear phase out is only the case for the next 2 years because of an act called the Inflation Reduction Act. Come 2026, we are set to revert to the old subsidy system. Now, the old subsidy system creates a cost cliff at 400% of the federal poverty level. With this cliff in place, at $100,000 worth of income, you would owe the full cost of a benchmark plan with no subsidies being earned. So things become much more complicated 2026 and beyond. Using hypothetical numbers here, at 399% of the federal poverty level, you might still be earning $500 or $800 per month in healthcare subsidies. Once you go over that 400% level, that subsidy completely phases out. So not only are we dealing with a prioritization problem related to conversions, but we're also dealing with two different systems that you might have to plan for or deal with if you're going to be on ACA past 2025. It seems that the complexities just continue to build. So let me give you a two-step process that we use with our clients to help make better decisions here. Now, understand all of this is very contextual to a client. Work with some retirees that will only be on ACA for 1 year, while others may be on ACA for a decade. The size of your retirement assets matter here significantly as well. But the first step in this process is to assess whether missing out on Roth conversions even matters. In the example we were using earlier in this video, it mattered quite a bit. Missing out on conversions meant RMDs pushed that couple into the 28% bracket and forced them to owe additional Medicare penalties. But what if the couple we were showing had, let's say, less than tax-deferred accounts in the first place? Now we can look at an updated tax chart that has them ruling out Roth conversions for the first 4 years of retirement, and then after they are 65, they begin those Roth conversions in what will be the 25% bracket, and they can completely avoid the 28% bracket and Medicare penalties later on because of those smaller tax-deferred balances. Said another way, if we can earn a healthcare subsidy and still fix tax problems later in retirement, then we don't have a prioritization problem. Prioritize the healthcare savings now and then begin conversions after. If this is the case, we're done here and we don't even need to go on to step 2 if we can do both. But what if we have a situation like what we showed earlier where prioritization is a problem or is something we need to figure out? Well, the answer is rarely all or nothing. If we dig deeper into the annual tax graph, we will likely find a middle of the road answer that makes the most sense. So if we were using the example that we showed earlier and we were just focusing on the federal tax rate, anytime we can pay a tax rate lower than 28%, we should be pretty comfortable Roth converting at that rate today. The reason why is because later into retirement, RMDs will force them to pay that 28% tax rate, again, plus Medicare penalties. Well, if we look at the cost of a subsidy phasing out and we translate this to a tax rate, we can make tax decisions a lot more clearly. For instance, here's an example of a retiree's tax graph with $25,000 preloaded into this graph, which signifies their minimum reported income. Anything above this would be a choice to show higher income levels. So if we did something like withdrew extra money from IRAs or did a Roth conversion, that will mean we are phasing out that healthcare subsidy, which is shown in that maroon looking color on the screen. The light blue then is the federal tax liability on those additional withdrawals or Roth conversion. Until this couple reaches 400% of the federal poverty level, their subsidy phasing out will be a fairly jagged and volatile cost based on that percentage schedule that we showed earlier. But once past that 400% poverty level, the rate add-on is a flat 8.5% rate. Even though the tax rate rises above 30% for a period of time, as you can see on the screen, there is a valley where it drops thereafter, and this couple would be paying a total tax cost of around 20%, which, as we've discussed, this couple should be willing to do to avoid that 28% rate later in retirement. And so most likely what this couple is going to want to do is still convert through those jagged added costs that we see earlier in the graph, move through 400% of that federal poverty level, and probably move all the way to the edge of that 20% or so rate with Roth conversions. And by the way, this is why I've said before in other videos, this type of tax graphing software is the most important tax tool a retiree can use on an annual basis. It makes incredibly difficult calculations very easy to understand. Click on the video in the upper right-hand corner here to learn more, as we've talked about this in a previous video. But if you don't have access to this type of software, you can do this by hand with a bit more work. For instance, you can go to healthcare.gov and compare plan prices based on your reported income level. Let's take a couple in Illinois that has the ability to show $40,000 of reported income. At this target, they would earn a $1,700 per month subsidy. If you raise this reported income by $20,000, their subsidy fades down to a little less than $1,500 per month. Well, if we do the math by hand, this would mean that healthcare costs would rise by at least $2,800. Now, because this cost is a function of increasing our income by $20,000, we can easily calculate out the tax rate add-on at 14.04%. Well, now we need to assess whether we are comfortable paying 14.04% plus whatever normal tax rate we would be paying on the extra $20,000 of income. Now, if this $20,000 conversion would be taxed at 0, 10, or 12%, and we were trying to avoid a 28% bracket in the future, it would make sense to do this conversion because our total tax rate would be less than that 28% zone that we're expected to see in the future. So there is a middle of the road answer here where some Roth conversion prioritization often makes sense. Now keep in mind, all of this math will change come 2026, but the same principles will apply. And this is where we need to continue to dig into the context of a retiree situation. I find so many retirees hate the idea of paying extra for healthcare when they don't have to. But let's reframe this situation. Here's a tax graph visualization of if this couple were to report only $40,000 of income. This Illinois couple has a decent taxable account they will use to sell certain assets with a high cost basis, so they are able to report only $40,000 of capital gains, dividends, but are living on more than 6 figures worth of income. Because of the standard deduction in the capital gains tax system, they will not owe any federal tax liability. All capital gains and dividends are taxed in the 0% bracket. Okay, now let's look at the same situation but with a $20,000 conversion. In the eyes of the IRS, your ordinary income, which a Roth conversion would be classified as, will stack first, and capital gains will stack on top. Because of this couple could initiate that $20,000 conversion, and it fits perfectly underneath the standard deduction, resulting in a 0% federal tax liability. The capital gains stack on top of this, but are still in that 0% bracket. Now, they still will owe extra for healthcare, which we've already calculated at a 14.04% add-on rate. But most couples should be thrilled with converting to Roth at a 14% rate given their situation. So by digging deeper into the calculations and data, we find exactly how much this couple should prioritize a healthcare subsidy versus Roth conversions. If you're interested in learning more about the tax tool that we showed earlier, click on this video right here where I describe it in deeper detail. Always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.